Alright, so class, let's look at the model itself. So dividends is equal to net income minus the bracket. You must first calculate the target equity ratio times with the total capital budget. Alright, so let's start with an example. Your capital budget is 800,000. Alright, to start a project is worth 800,000, and the target capital structure. Alright, target capital structure means how you're going to finance this 800,000. Alright, it's going to be how much going to be debt, finance, and how much will be equity finance. So the capital structure is stated this 800,000 will be financed by 40% debt and 60% equity. And the forecasted net income is 600,000. So how much of the forecasted net income should be paid out as dividend? So class, can you guess how much it would be? Your net income is 600,000 minus your target equity ratio is 60% times with your total capital budget 800,000. So 60,000 times 800,000, you get 480,000. So 600 minus 480,000, you should be getting 120,000 as the dividends. So that is the residual that you'll be paying out as the dividends. Alright, so 120,000 is the dividend, and you can calculate the dividend payout ratio, which would be from the total income, how much dividend are you paying? So 120,000 divided by 600,000, which is 20%. So dividend payout ratio is 20%. So what if the net income drops to 400,000 or increase to 800,000? How did your decision will change? If it's 400,000, what happened? 400,000 minus, just now we have already calculated, it was 480,000. Therefore, you get negative 80,000. So negative 80,000 means what? Negative 80,000 means, does it mean you're going to ask the shareholders to pay dividend? Definitely no, right? So that means you cannot pay dividend. Alright, from the profit you're going to keep all of the 400,000 as retained earnings. There's no residual. Alright, there's no balance. Only when there is balance you will pay out as dividend. Right, so in payout ratio, of course, 0 of 400,000 is equals to 0 percentage. So what if it's 800,000? Your net income is 800,000 minus 480,000. Your dividend would be, of course, much higher compared. Earlier it's 320,000. Guys, you have a big residual over here. Moving on. How would a change in an investment opportunities affect dividends under the residual policy? Alright, so the logic here is, if you have less good investment, if you have less good projects, upcoming projects, then your capital budget will be small. When the capital budget is small, therefore your dividend payout will be higher, right? From the, let's say, from 100 million profit, let's say you have only 10 million worth of future projects that you have planned. So the remaining 90 million you can pay out as dividend. Alright, it's if you have, let's say, 80 million worth of projects waiting this. If your profit is 100 million, out of the 100 million, you take 80 million as retained earnings for the future projects, remaining 20 million you pay out as dividends, right? So less good investment, you can pay higher dividend. More good investment will lead to lower dividend payout, right? So that is the logic behind. So let's moving on to the next one would be comments on residual policy. Let's look at the advantage and disadvantage. So advantage would be minimizes the new stock issues and flotation costs. Alright, as we just discussed earlier, the good thing about residual dividend policy is if you already pre-planned, once you already pre-planned, as I mentioned, let's say you have 100 million profit, next year is 80 million worth of projects waiting. From the 100 million, take the 80 million as retained earnings. Keep it aside. So the next year you don't need to depend or don't need to find new way of financing, whether taking a loan or issuing new shares. You don't need to do that because you already have existing retained earnings to use. So that reduces a lot of hassle and additional costs. But the disadvantage would be results in variable dividends. Right? Just now we learned, right? Some companies, they were giving stable dividends every year, same amount of dividend. If you have resident dividend policy, you can't do that. Alright, because depends on the profit and depends on the new projects. Alright, the residual dividend will change, or the dividend payout will change. Signs conflicting signal. Right? Why? Because if let's say in 2019 you pay a high dividend payout because you don't have big projects, but in 2020 you pay a lower dividend payout because you have bigger projects in 2021. So that gives conflicting signals. Is this company paying high dividend or low dividend? Alright, so you don't, that increased risk in the sense you don't really attract a certain type of investors. Those who like dividend payout, they don't really follow you because one day you're paying, one year you're paying high dividend, another year you're paying low dividend payout. Or those who like capital gain also, they might not like you because you do pay high dividend on certain years. Alright, so you don't appeal any specific clientele. Alright, next. The conclusion would be you can consider residual dividend policy when you have a long-term target payout, but don't follow that rigidly every year. Alright, if you follow that every year, then there will be a situation is you just look the disadvantage. Can't really appeal specific clientele. So for long term, you do that, but every year don't follow too rigid. So how to set a dividend policy? The first thing you need to do is you need to forecast, project how much capital you need. Alright, for example for 5 years. Then you set a target capital structure. Then you estimate annual equity needs, how much equity you need to be funded for your capital structure, and you set the target payout based on the residual model. So generally some dividend growth rate emerges, and try to maintain the target growth, if possible, because varying capital structures somewhat, if necessary. If not, you don't do that. See, for example, let's say you need 100 million. Alright, you need 100 million for your capital budgeting for the next 5 years. So for the 100 million, you need to set the target capital structure, which means let's say 50% debt, 50% equity. Alright, which means 50 million to be funded by equity, another 50 million funded by debt. And then you estimate your annual equity needs, which means If you need 50 million equity, then every year you need 10 million. Alright, so once you know your annual equity need is 10 million, then if your profit is 20 million, you keep 10 million for your future project, your annual equity need. The remaining you pay out as dividend. And here they're trying to say is don't try to keep stable dividend payout, because varying might not attract a specific client. Moving on. Stock repurchase. Okay, stock repurchases. Now we're going into shares and what kind of shares. Alright, so share repurchases means the company is buying back the shares from the shareholders. Right, this happens. The company buying back the shares from shareholders. The reasons for this is instead of paying dividends, alright, when the company made, let's say, 100 million profit, instead of paying dividend, they can use the money to buy back the shares. Right? So that is an alternative way of distributing cash. And another reason would be dispose of one-time cash from asset sale. See, let's say every year your profit is 100 million, but all of a sudden this particular year your profit is 300 million, and the reason is because you sold a piece of land. Let's say you sold a piece of land for 200 million, so all of a sudden for that particular year your profit is too high. So if your profit is high and if you try to pay high dividend, okay, then again there will be a situation, the market start thinking, oh, this company is paying high dividend, so maybe you should invest in this company. And then the next year you come back to the normal trend, which is 100 million. Then you end up paying lower dividend payout. So that kind of disappoints the investors. So when you have one-time cash surplus, what do? You use the money to buy back the shares from the shareholders. So it doesn't affect the dividend policy or dividend payout. And to make a large capital structure change. Another reason would be you want to change. Let's say previously is 50% equity, 50% debt. So you want to change, make a major change, you buy back the shares. Alright, so that your debt ratio increase while the equity ratio drops. So what's the advantages of repurchases? Shareholders can actually decide whether they want to sell the shares or not. Alright, unlike dividends, the shareholders cannot decide whether they want to accept the dividend or not. But for repurchase, shareholders can decide whether they want to sell or not. Helps avoid setting high dividend that cannot be maintained. As I mentioned, if there is sudden surplus or very high profit, then you don't want to pay high dividend payout, you can't maintain. Repurchase shares can be used in takeovers or resold to raise cash needed. Right? The repurchase shares, you can reissue it in the market. Income received as a capital gains rather than higher tax dividends. Alright, so this has become a capital gain. Why? Because you only receive capital gain when you sell shares, right? So now you're selling shares back to the shareholders, therefore that would be a capital gain compared to higher tax dividends. Stockholders may take as positive signal management thinks stock is undervalued. Alright, so in this kind of situation, the investors will take it as positive, alright, and they think the company shares are undervalued. Okay, what about the disadvantage? It could be also viewed negatively. Alright, it could be it might show as though the company has no attractive investment opportunities. They can also see it that way. Alright, since you're buying back shares, it means that use tremendous amount of cash. Alright, so when you do that, people might think, why are you wasting your money, why wasting your cash to buy back shares? Why don't you use that to expand the business? Alright, so it can be negatively viewed as well. Alright, this is the inland revenue could impose penalties if they found out that the repurchase is to avoid taxes on dividends. Okay, selling shareholders may not be well informed, hence be treated unfairly. Right, so sometimes only the majority shareholders who have the knowledge about this, but the minority shareholders might not have the knowledge and they might not be able to sell the shares. Alright, firm may have to bid up price to complete purchase, thus paying too much for its own stock. Alright, it's like it's not outsiders buying the shares, the company itself buying back the shares from the shareholders, and they might end up paying higher share price, right? Compared to the market price, they might end up paying higher. So that is totally not necessary, right? Because you're wasting the company's fund to buy back the shares from the shareholders and sometimes paying higher value than the market. Alright, so let's move on to the stock dividends. Alright, so what is stock dividends? The stock dividends, for example, firm issues new shares in lieu of paying a cash dividend. For example, if you have 100 shares, you will get 10%, which means 10 shares. So instead of cash dividend, you get shares as dividend. Okay, and stock split on the other hand is 2 for 1, which means if you have 1 shares, it will be split into 2. If you have 100 shares, now you have 1 shares into 2 shares, right? So now you have 200 shares. Right? So that's another way of giving back money to the shareholders. One is to giving more shares. Alright, it's like a bonus shares kind of thing. And then you have stock split. From 1 shares you split into 2. So instead of 100 shares, now you have 200 shares of the company. Stock dividends and stock split. So let's look some details on this. Both stock dividends and stock split increase the number of shares outstanding, so the pie is divided into smaller pieces. It means previously if you have 5 million, let's say total number of shares in the company is, let's say, 5 million. After stock dividend or stock split, maybe you have 10 million shares. Alright, so the pie is divided into smaller pieces. Let's say last time you have let's say 5 million shares is divided equally by 5, now equally by 10. Okay, unless stock dividend or split conveys information is accompanied by another event like higher dividends, the stock price falls so as to keep each investor's wealth unchanged. See, when there is a stock split, alright, so let's say last time 5 million shares you are selling it for 2 ringgit. Now after share split, you have 10 million shares and each shares will become 1 ringgit, right? So last time 5 million shares you sell it for 2 ringgit, so your equity value is 10 million. Now being stock split, you have 10 million shares and your share price will also reduce to 1 ringgit, because at the end your net worth or the investor's wealth will remain unchanged. Previously 10 million, after split is also 10 million. And the reason for split, it could be because they want to achieve the optimal price range. Sometimes the share price could be too high, let's say 200 ringgit, 150 ringgit. So they want to split it so that they can reduce the share price, right? Or to reach the optimal price range. See, for example, optimal price range is around 20 to 80. Anything more than 80, it becomes difficult for an investor to purchase. Alright, so that is why they split. And stock splits generally occur when the management is confident, so it's interpreted as positive signal, right? And on average, stocks tend to outperform the market in the year following split. Alright, usually after you split, the share price drops, right? Because number of shares has increased. But what will happen after share split? The following year, the share price will increase again, will outperform the market. Alright, so that is the trend line. Alright, so with that, I will end the session on dividend policy. Thanks.